All right. So, John, we are having this recorded, and attendees, we're going to have this recorded so we can send out to all the clients who did miss it. Okay. So, thank you for attending the first ever Coffee with Riverbend. I'm drinking water because I had my coffee at 5 a.m. already, so it's all good. But welcome, welcome. What we're going to do today, the agenda for today. Thank you, John, for attending. Um, John Nickel, that is the agenda for today is to, number one, have John Nickel talk about state of the economy, state of the market, state of the Fed. All right. We're going to try to do that in 5 minutes. Then we're going to go over a couple technological things that we're doing here at Riverbend to help us help you, and then open up for questions. All right. If this lasts 20 minutes, great. If it lasts an hour and a half, great. This is to hear what you see and what you want and what questions you have, and helps guide us going forward. This is the first of our Coffee Riverbend series, and we hope to plan on doing this every quarter, and we'll go forward. So, John has been a money manager, dare I say, 30 plus years.
92. We're getting.
Oh, wow. Do you know that actually is over 30 years?
Don't
Yeah.
remind me.
Yeah.
We're just talking about me here losing my hair and it's turning gray. Okay, let's.
Yeah. Well, I mean, being a money manager for 30 years, if you have any hair, it's a plus. Right. So John was a money manager with Federated Funds for over almost 20 years and had over $8 billion in assets, managing a balance fund there. And now he manages money, he and his team, with Fundamentum, and we use Fundamentum a lot with some of our clients. And number one, they're able to offer for us customization, which is big, big, big. Number two, I love that they look to manage downside risk. And number three, they're accessible and able to do things like this, which gives us a bit of transparency in helping us help you. Okay. And so, John, hey, tell us what you think about where we are in this world today.
Well, two things. I'm not drinking coffee. I'm drinking hot chocolate. So I'm going to call this hot chocolate with Riverbend. I haven't had
Okay.
coffee in 10 years. So
10 years.
that's another story.
Is
It's
there a
actually
12 step? Is there a 12-step group for that? I don't know.
but it's less caffeine. So
Gotcha.
okay, the market. So it's been an interesting time in here. Let's sort of forget what happened in 22. Markets were down. Not only were stocks down, but bonds were down. And we had a very impressive start of the year where bonds rallied, the stock market rallied. And what's going on is the interaction between four things. It would be the economy, inflation, the Fed, and profits. That's sort of the four things that one day one thing will lead the arguments and the markets might be up. The other day, something else might lead the argument and the markets will be down. What we're sort of thinking right now is what's leading the whole discussion right now. You had a positive January where the markets were up 5 to 10%, depending upon what stock. A lot of that was just a rebound off the lows of last year. A lot of it was turning the page. A lot of it was tax loss selling, where you sold some of your losers from last year in November and December, and you bought them back in January. Some of it was the belief that some of these companies are real. I will say that Tesla is a real company. They are actually making automobiles across the globe. I would say the question I have with it is, what do you pay for it? I mean, now that it's rallied significantly right now, I think it's a little overvalued. But back in late December, early January, the multiple for that high growth stock was interesting. It still has a lot of risk with it, but it was interesting. So what we're looking at right now, let's just talk about the four things I mentioned. Inflation, that's a positive. It does look like inflation, not that the Fed has put inflation back in the bottle, but we're definitely off the peak in the summer. But inflation has fallen from the 8, 9, 10% down to 4 or 5%. Now we have some work to go to get it down to the 2 or 3% where the Fed's comfortable, but the path, the glide path, instead of going up, which is bad for all financial instruments, the glide path is down. So that's sort of positive on that front. That will at some point allow some flexibility for the Fed. But right now, the Fed does not have that because we're not at the 2 or 3%, which is their goal. We're at the 4 or 5%, running rate. So that means the Fed is continuing to raise rates, and they probably will keep rates higher for longer. You'll start hearing the higher for longer mantra. What's happened recently with the markets had two good thoughts that caused the markets to rally significantly in January. One was that the belief that inflation was finished, and two, that we were not going into a recession or a slowdown. We were going into a no landing zone, and that the Fed was going to cut rates in the second half of the year. So that's actually pretty close to being Goldilocks for the markets, and you had the markets rally strongly. Unfortunately, if you look at it, that rally was only due to price multiple. It wasn't because earnings were going up, it's because the multiple was expanding. Remember, 22 was a year when the multiples contracted from the all-time highs of 22 times earnings down to like 16 times earnings. What we've done right now is we've gone from 16 back to 18. So that's sort of what you're seeing right now in February is we're trying to decide which way the market should go. So you have the Fed that's basically saying we have to keep rates going up at a lower rate, not the 50 basis points they were doing, but at 25. So we're looking for rates to go up in March. They'll do a rate hike in March. They'll probably do a rate hike in May. We actually think they'll probably do one in June also. So something north of 5% is where the ultimate, cap in the Fed's fund rate is going to be, which probably is good news for savers because that means they'll be able to get a 1 year, 2 year, or 3 year CD, for a short time period. But it's bad news for corporations and it's bad news for financial stocks because of valuations. So we look at the economy right now and say, what's going to happen with the economy right now? The economy is definitely slowing. You're seeing that the economy is sort of slowing, and you're seeing that earnings are also slowing. Last year not last year, the fourth quarter had earnings growth slow for the first time the whole year. And so that's what we're expecting to go forward is we expect earnings to continue to slow. We expect the economy to sort of stabilize and to slow here, but we do not think you should pay 18, 19 times multiples for that with inflation at the 4 or 5% zone. So we're a little cautious right now on equities, U.S. equities. We actually like international equities. We think the valuations are much more appealing there, and we actually have warmed up significantly to bonds. We think the case of last year, where it was the first time I think since '72 where bonds were down over 10%. The bond ag was down over 10%. We think that occurrence will not happen again. The biggest risk in the portfolios of the clients right now is a profit recession, an earnings recession, or an economic recession. And those generally are favorable to bonds. So we believe bonds are going to be the anchor that they've been over the last 40, 50 years. Unfortunately, they were not that last year. So we've actually increased our exposure to fixed income across the board. We're a little cautious on credit. So we're not buying into the high yield area, but we are buying into corporates. We are buying into treasuries. We think that's interesting. Then we do think that equities we sort of have a risk reward ratio of equities right now of an up with the S&P. Let's say it's staying at like 4,000. We have an upside scenario of earnings go up maybe 5%, which we don't believe, but we're looking at our upside. And so we have a multiple of where we're at now, and that's like a 4,500, 4,600. So you have basically a 10% upside scenario, we believe, on the positive side. On the negative side, our base case is we have flat earnings with multiples that are lower, which brings us down to like a 38, 3,900. The downside is if we go into a recession, and in a recession, typically earnings fall about 20%, which if that happens with appropriate multiples, you'll get something in the 34, 3,200. So the risk reward's not interesting right now for equities, but it is for fixed income. So that's sort of where we stand. We stand, positive with fixed income. We're sort of in a holding pattern for equities. We had a strong January. We're trying to digest those returns now. The markets are now believing that the Fed's going to raise rates more. There used to be some discussion, oh, is the Fed going to blink or the market's going to blink? It looks like the market lost and they blinked. Rates have gone up. The 10-year I think it's about 3.9 right now. A couple months ago it was like 3.4, 3.5. So rates have gone up, and the expectation of a Fed cut in the second half of the year has dissipated too. Ironically, so the fixed income market's reflecting that, but the equity markets have not. So that's what's going on right now. Positive part of that is the equity markets are glad that we're not going into a recession, and so there's some positive news going there. Okay. So that's sort of where we stand right now. We're sort of defensively positioned. We're looking to be a little more aggressive in equities, but we're much more aggressive on the fixed income side.
Okay. And then of the equities that you're in, you're leaning more towards international now.
Right. Now, okay. I would say just two things I've thought about it. Internationally, there is two risks out there. Well, one's a positive risk and one's a negative risk. Let's talk about the positive first. China is reopening. So that's a big positive for earnings and for the economies of the world, as they've basically been closed for the last 3 years. So that should be a positive influence, a tailwind for economic activity across the globe. The negative side is what goes on with Russia and the Ukraine war. Does that develop more? We're expecting Russia's going to try to make some last big hurrah before the U.S. and Germany, roll their tanks in there, because once that happens, there's probably no option for Russia to take, what they want. So the next month is probably critical in that area.
Perfect. Thank you, John. A quick question for you is China opening up? Would that be deflationary in some respects because of production and things like that?
It's a broadsword. It's a two-edged sword. Originally, it should be a positive where supplies will get refurbished, which means that should cause inflation to go down because the input costs for manufacturing should go down. Mm-hmm. So that is a plus. The negative about that is they're actually going to have to use more oil, more coal, more nickel, more iron to build things. And so you might get some commodity up too. So it's sort of a broad, I guess it depends on where on the spectrum you are. If you're building something, it's probably deflationary. If you're a basic material type person, it's probably going to be a little inflationary.
Okay, perfect. Thanks, John. John. Hey, little housekeeping. On the right-hand side, there's a chat feature. You could type in whatever questions you have, or you can raise your hand. Guys, this is the first one that we're doing here, and we're going to get this thing down. But type whatever question you have. If somehow technology doesn't suit you, you can send an email. I'll be monitoring that to me as well. But if you could type in here, I'm going to say type questions here. Any questions for John?
Well, while we're waiting for that, something just came across the screen that both Walmart and Home Depot actually reported their earnings today, and so it's interesting. Unfortunately, Walmart missed their expectations, so that's sort of dragging the market down. Walmart actually beat their earnings and their revenues, but they sort of said the consumer is a little cautious, and that was enough to turn the a little negative. So you sort of have the retail stocks that are saying the economy is not as good, as we expect. Those rate hikes the Fed has done over the last year are maybe having an impact across the board.
Okay. Now, when they say not as good, is it still a positive, or it's hard to say what? I mean, you just saw this, so maybe you don't see.
This is one of those things where is bad news or is bad news good news? That's what you always see with the market. It looks like Home Depot had bad news, that they missed their earnings, they missed their revenues, and their guidance was subpar. Walmart's a little up in the air because of their grocery business. They did very well on their current earnings. They just sort of lowered expectations. So that could either be bad news, or it could be management just trying to manage the economy, manage what people think about them. So what I would view this as the question of, remember I said that the 4 points, there's the economy, there's inflation, there's the Fed, and there's earnings. This is definitely not what I would say a positive on earnings. So that it's probably a warning shot that there's something brewing in the earnings area.
Okay. Understood. Understood. Well, we are thankful that we have you and your team amongst many other resources that help manage this for our clients, and I do appreciate it. I'm gonna yeah. So whoever's on the webinar here, feel free to type your questions in there. Right now, what I want to do, John, is I want to transition and go over a couple technological features that we're using here at Riverbend, and to help the clients see what's available. A lot of times, like I'm gonna use this analogy. So a lot of times I'm hungry and I'm at the house and there may be nothing in the fridge. Now that rarely happens because my wife does a great job, but sometimes there's some things in there that I can't see. I don't even know that they're there. And if it's not, if I don't know it's not there, then it doesn't help me, right? So I'm going to share with that. Oh, I think I got a question here. Here we go. All right, great. Assuming the Fed is able to regain control of inflation, what are your thoughts when we might see inflation back to 2 or 3% range again? Yep.
I like the word assuming, so on that, because actually in the 70s the Fed thought they had inflation under control, and then it got way out of hand. I think that's one of the things that when you listen to Chairman Powell, he sort of says we'd rather mistake on beating inflation down than letting it up. So what we envision, at least 3 more rate hikes. The key number you want to look at is next month's or February's jobs number. The January jobs number was fantastic. The January retail number was fantastic. If those 2 numbers are still strong in February, you're probably not only going to get a 25% rate hike, you might get a 50 basis point rate hike. So what we envision is the battle is going on. I would say this is the 7th or 8th inning that the Fed's, going to raise rates through the summer. They will pause in the fall. And I think what that means, I would think in 2024, you'll see the rates that we expect. The question will be, along with that 2% inflation number or 2.5% inflation number, are we going to be in an economic recession too? That's what's going to be the debate going, once we come into the summer. Right now, the key is to, can the Fed, slay inflation? The next one will be, can they do it without sending us into a recession? That's what's the back and forth is. But we look for the 2% number to be sometime in 2024.
Perfect. Thank you. Thank you very much for that detailed answer. Feel free again to ask whatever questions. I'll see the question pop up, and we can loop in John Nickel and.
But let me just I'll poke my nose in where I probably shouldn't is. So going forward with that question, so if they get control of inflation in 2024, remember the equity markets are a discounting mechanism. So they will probably discount that 6 months forward. So that potentially means in the fall of this year, we would be warming up extremely to equities at that point in time. So that's just one thing to think about.
Now, John, let me ask you a question though. Is there some like green flag that someone says that makes you think that all of a sudden equities are going to be good going forward? I mean, there's no light that turns on that says, okay,
no, it's a mosaic is the lottery. The one thing we like to do, there's two ways. It'll either be time or it'll be the market's correcting. We like to be positive on equities when there's a risk reward. Like you think about when you're batting average, you want a batting average over 300. You don't want a batting average of 100. So if the markets pull back into the 3000s, that means the risk reward is much better, and we would be overweighting equities. At this point in the 4000s, we're not there yet. The other one would be time, is if we start looking into, we're expecting 24 to still have positive earnings. So if earnings are up 10% in 2024, that makes valuations and risk rewards look a little better into 24. The problem is we're sitting here in February. I'm not going to look out into 24. It's a year. Well, it's 10 months away. I'm not going to look out that. So that's the two things: time or a correction is what we would cause to do that. I guess the other thing that could happen is earnings could come out and be very positive, which would be a very big surprise to me, because we think earnings are going to be flat to down this year. But that is another one that would cause us to reevaluate.
Perfect. Thank you, John. I appreciate that. Yeah, so you want to wait till the odds are in your favor, risk return.
Right.
That's one reason why I like you guys is that when people are taking money, typically our clients are getting right at the edge of retirement or in retirement. In that, it's okay if the market, let's just say, for instance, market's up 10 and they're up 8. What isn't as good is that if the market's down 10, they're down 10. I'd like to, I'd rather than be down 8, 6, 5, 4, something like that, to give up a little bit upside, but protect a lot more on the downside. And typically for people who are taking money out and living their life. So
yeah, we sort of look at, wealth creation is great, but we look at wealth preservation as key. I mean, that's sort of when we're flying our plane, that's what we're looking at.
all that being said, and all that being fair, the reality of 2021, every single part of it. I mean, unless you own a bunch of gold, a bunch of oil, it
Right.
was a
Actually,
rough, it was a rough ride.
Your typical 60-40, 60 equities, 40% fixed income had its worst performance, I think, since 1938. So it was a highly unusual event. I mean, the good news, we've turned the page to that. I mean, the other good news is I think fixed income is going to act as the volatility anchor that it historically has. And equities I'm not shouting that you sell equities. I'm not shouting that you buy equities. So I guess it's much more after 23. There's much more opportunities around the world.
Yeah. All right. Wonderful. Here's the thing, dear listener, is that, it's not a light switch. You don't go to like 100% off or 100% on. Hey, just be a bit methodical and, and strategic. And that's what we got John here for, things like that. If you look at a light switch, dimmer switch, I've written about that on our blogs, but just being a bit defensive. And that's what John does is being a bit defensive within the equities and having higher cash positions, a bit more defensive. And then with things get a little bit more clear, that you rotate back in again.
Right.
There's not a big yellow light.
There's actually a couple ways you can do that. You can do that through asset allocation, and you can do that through sector weights or stocks. For example, two stocks that we're looking at is NVIDIA. It's a very high fundamental gaming semiconductor. It has a very high beta, which means it's very volatile. The one that we like right now is Texas Instrument. It basically, people probably heard of it. It basically has semis and everything, from automobiles to garage doors to everything. And so it has some of the same exposure. They're both in technology. They're both in semis. One is just one that swings for the fence, and they're actually hitting on 9 cylinders right now. Where Texas, it reminds me of the tortoise and the hare. Texas Instrument is the hare that's just plodding along, growing at 10% a year. Technology is a great place to be in, but they're not going out over their skis. NVIDIA is the other thing. One of the things NVIDIA got very involved with is the mining of Bitcoin. People were buying their chips to help mine Bitcoin. Now, that's not really what I would call a strong, repeatable business. It's still a great company, but that's what causes the issues. So there's a couple ways you can play the markets. I mean, we have actually a buy list of stocks, whether they're growth stocks, whether they're value stocks, whether they're small cap stocks or international stocks, that we're waiting to put in place when we think the time is right.
Perfect. Hey, little disclosure here, guys, is that John is talking about what's in his portfolio. He's not recommending these stocks for you individually, right? Okay. So, yeah, absolutely. So, so that's one thing to keep in mind. That reminded me, I just got to make sure that I have the proper disclosures at the end of this, talk. So, all right. So I'm going to get real quick into some of the technology that we're utilizing here at Riverbend. Some of which you know, and some of which you may not know. All right, so I'm gonna share my screen, and John Nickel, just be ready to be amazed. Look here, I'm gonna have fun doing this.
This is fun. I like this.
Look, I mean, I'm not gonna be here all stiff and boring. Well, some people might say I'm still boring. All right, here's the deal. I say you, the client, you now have the ability to chat with us at Riverbend via text. Okay. And here are the numbers, and feel free to take a screenshot of that. We're also going to be able to, we're going to send that out to you in the replay, but you can chat, you can text these. This is a secure chat feature that when you send that chat, we get notified. And so a lot of times people are able to communicate better through chat. And those are the numbers from the chat. Okay. And you can ask whatever questions you want. You can have, hey, Rox, send me a check, and then she can follow up the phone call to make sure it's still you and all of that. And or hey, what about my statements, or whatever the case may be. You know what to do. You can do it through text now, and those are the numbers. Questions or thoughts on that? Questions or thoughts on that? Okay. All right. So another thing I want to share with you, and almost every single client has gone over this, and this is our baseline information. This is our tool that we use for retirement planning, and a lot of times people just want to look at the dollar amount of what your account value is. This right here is, in my opinion, way more important. This is your overall financial picture. All right. Hey, money is used to do what? All right. Hey, it's Jeremy. I want to retire. I want to sail around the world, or I want to teach yoga, or I want to stay at home. And yeah, all of those things. So this translates all the stuff that you've got going on into a financial plan. And this goes at your probability of success. In this particular case, it's 98%. It's also got your balance sheet with all your assets in it, your current allocation. Again, this is just an example. And then, so a lot of clients may have this information here, and we use this. They say, hey, Jeremy, I'm getting a loan for something. Can you send my balance sheet over to my banker? Absolutely. Okay. And then we can send it over directly to them. Also, this is important for us to keep up to date. All right. Hey, you win the lottery. Guess what? We need to know about it. You get an inheritance. We need to know about it. All of this stuff matters. And it matters because, like, if you need, let's say, $6, $7, $8, $10, $20,000 a month to live off of, and you have something materially different, it can improve your situation or make it a negative. And make it a negative doesn't necessarily mean it's going to derail your whole picture. It just may delay some certain things. Okay. Also, this also helps us in the area of tax as well, so that when we can try to be as tax efficient as possible with the investments. Okay. I am sharing the correct screen. All right. Do you see this distributions and conversions? You see that,
yeah.
John? Okay, yep. Perfect. All right. All right. Hey, one other thing I wanted to point out here. You see these three little dots right here? This is a secure digital vault. Okay. So let's just say you got your estate planning documents. By the way, I hope you do. If you don't, we need to get them, or you need to get them. And you drop those documents in this vault. Instead of emailing those big documents over to us, this is a very secure way to share information. Not to mention is when we have that information, and God knows if something happens to you or your spouse, someone's going to raise their hand and want us to, someone's going to raise their hand and say, hey, Jeremy, what do I need to do? When we have those digital documents on file, it helps us help your next generation or help your spouse. And guess what? It also helps us be more tax efficient. Hopefully you can drop in your 2022 tax return in there so we can start running your information through our tax software, and to make things as efficient as possible. Okay. And this is also, all of a sudden, it's got goals in there. Your goals change. Guess what? Hey, I can live off a half. Great. or I need double. Okay, great too. Let's run it. You buy a house, sell a house. Let's see how it affects your overall situation. Also, when we have your estate documents in there, we can see how your assets are broken down. Through our process, we make sure that we have the beneficiaries correct and your estate documents up to date, and keep you on the right path. Our intent is to use these tools to kind of hopefully alleviate the worry financially so that you can live your best life. Spend time with your spouse, spend time with for your loved ones, do the traveling or whatever you want to do, whatever your best life is for you. That is our intent, offloading that burden of all of this crap onto us so that you can focus on the things that are important to you. And it's unique to you. Questions or thoughts about that? Questions or thoughts about that? All right. All right. So before
I should say, sign me up. That was actually pretty cool. I like that whole presentation. So
well, you know, I've been doing it so long. That's just what, well, it's just, look, really, really and truly, I'm not CFP, SEMA. I've seen every daggum dog and pony in the world. At least I feel like I have. And it's, the money's a tool for what? A tool to help you do what? All right. So there's two questions really that helps people think about getting on the right track mentally. If you were to die tomorrow, what would be your biggest regret? Okay.
right.
All right. Or what would you want to do today? Typically, it's about spending time with loved ones. Typically. Okay. Or whatever. I don't know what it is for them. Another question is 20 years from now, if you look back on today and the past 20 years, so that's 20 years from now into the future, what would you want to do more of? What would you want to do less of?
Right.
Right. A lot of times when people put things like that in perspective, they start living with more intention. And living with more intention that is more meaningful to them.
Right.
You know, and so if people just look at, hey, market went up, I'm happy. Market went down, I'm sad. Man, that's a miserable existence.
Well, and like
my opinion.
retirement's not a negative word, especially like if they can have a control of their finances, which, funny, a lot of people don't, but they really should.
Yeah, no, absolutely. Retirement doesn't necessarily mean just sipping Mai Tais on the beach. It means whatever it means to them. A lot of times retirement means going back to work, but going back to work and doing the things that they love to do. So that's something. A lot of times retirement means changing from one stressful job to a job that they love, or retirement may mean going from full-time work to part-time work, whatever it may be.
Right.
A lot of times it's just independence. It's just the ability to be able to say, I'm done, but not be done if they don't want to be done.
Right.
So, but it's not, how many times have we heard the cliche? It's, it's stop and smell the roses. Right. And a lot of times what people do is they will bound up a lot of pain of what's in the future, and they dump it on themselves. I don't know what's going to happen. I don't know what's going to happen. I don't know what's going to happen. And they miss all the roses that pass them by on a daily basis.
Right.
And dadgummit, that's not our intent.
That's not a way to live.
No, it's not. All right. But guess what? Just like, I mean, I'm hard-headed, John. I know it may seem like I have, but I'm hard-headed. And I sometimes need to be reminded, hey, wait a second. Let's smell the roses. Let's hey, just enjoy the coffee, or let's have fun in a webinar, or whatever the case may be. And or just real world. Hey, I didn't have the disclosure up. I was like, wait a second. And yeah, I'm gonna write that down. So the next time we have coffee Riverbend, we'll have it. So, okay. With that being said, I know everybody's waiting with bated breath. Here's the disclosure. Hold the applause. Hold the applause. All right.
It's up there.
There it is for your viewing pleasure. I can see all the compliance officers now nodding their head and applauding. Okay,
They're breathing a sigh of relief now.
yes, that's right. That's right. By the way, the background there is Myrtle Beach.
Is it? Oh,
Yeah, it is. That's Myrtle Beach. That's the sky wheel there and all that. If you see over here, like right over, oh, wait. I'm going to show you. About right there is Riverbend. About
okay.
right there where my cursor is, and about right over there is where I live. Not on the beach, but not far from the beach. So, oh, hey, we got another question. Okay. Oh, here we go. There we go. We hear a lot in the media about many folks who feel the U.S. economy is currently in very bad shape. What's your opinion of the overall state of the U.S. economy?
What I would say right now, the economy is actually better than what most people think. One of the things we look at is the Atlanta Fed does a little estimate of what GDP is. And actually the GDP, which is gross domestic product, is actually gone up the last 2 months. So there's some positive news, I would say surprise strength. Because historically, what happens when the Fed raises rates, they put the economy into a recession. Unfortunately, that's what sort of happens. That hasn't happened yet. So right now, inflation has come down, but the economy is still surviving. The jobs number, we had over like 500,000 jobs. We had a strong retail sales number. So those are very positive. The problem I have going forward is we're not at 2% inflation yet. We're still at the 4, 5, 6. So the Fed's not finished, which means rates are still going up. And so it's going to take time. So as of right now, the economy is okay, but there are signs, like I said, in earnings, that earnings are starting to weaken a little, or guidance is coming down. There are signs that there's some cracks in the job market. But as of right now, the economy is actually, fairly good. Quite honestly, that's one of the reasons why in October, November, December, and January, the markets rallied, because there was a fear that we were going to go right into a major recession, and we did not do that. It doesn't mean in 2024 we can go into a recession, but it just means at this moment in time, there's still a battle going on, and it's undecided whether we go into a recession or not.
How correlated is U.S. stock market returns with U.S. economy or overseas?
I would say it's correlated, but there's lags. Usually the U.S. stock market leads by 6 to 8 months. So what the rally, I would say, from October through January, we're saying, oh, we're not going into recession in the first half of 23. And lo and behold, it looks like we're not going into recession in the first half of 23. What happens? The question now is do we go into recession in the second half or in 24? So I would say the markets lead sort of the economy, but ultimately the economy is the key driver. The economy drives earnings, the economy drives growth, and the economy drives the Fed. And so those two sort of things are what ultimately leads for the market, the equity markets.
Sure. By the way, when we do these financial plans and things like that, we randomize the returns to help protect. I say protect, that's not the right word. We want to make sure that you can live your life regardless of the economy. All right. And we do that through cash positions and secured income, through Social Security maximization, being tax efficient, and a few other things. All right. Now, that doesn't mean that we predict the market, but what it does mean is that we try to put airbags wherever we can. So, right. Hey, guess what? If we get in a wreck, hopefully it won't be bad. And if it is bad, then we have some protection. And many people, their portfolios went down last year, but they're still stayed retired, and they still don't have to go back to work unless they want to. Okay. So that's a way that, yes, that people can still hopefully live their life without the fear of something going down the road. Yeah, as well.
Yeah, in our business, we sort of call that risk-adjusted returns.
That's right.
That we look at it and sit there and say, yeah, we could be swinging for the home runs and get that stock that's up 80%, Yeah, and then the client would say, "Oh, you did a great job," but then the next year it could be down 70%, and they so we try to avoid those. We try to give the steady eddy or repeatable returns. So it's sort of the same thing whether it's retirement or investments.
And that's why we like what you guys do. But for that reason, because it's there's emotionally speaking, there's been studies done. You probably, I don't know if you know this, but you probably do know this. You're a pretty sharp guy. Is there's been studies done that if someone won $1, it is not nearly as beneficial. It's 3 times less beneficial than if someone lost $1. So the level of pain someone experiences in losing $1 is 3 times more
Right.
than the pleasure they have in a gain. And so that affects emotionally things. And so we try to be a little defensive with that because again, we're trying to help, our people, our people live their best life. And so without, without worry or burden. So
That's like risk profile is what we always look at. We look at the risk profile of companies and stocks and bonds. You look at the risk profile of your client, and it's sort of the same thing.
that's right. That's exactly right. That's exactly right. Any final questions from the viewing audience? Any final questions? Final questions.
Well, one thing I'll throw out there that if they do decide to ask you a question later, we can always,
Yeah.
I'm always available, for Jeremy and his group to follow up. And we've done individual calls and stuff like that. So I'm more than happy to do that.
Perfect. Thank you very much, John. All right. Here's also one final thought is whatever you think was good, let us know. Or better yet, if there's something you would like us to discuss on the next Coffee with Riverbend, which would be probably in 3 months or so, let us know. Our intent here is to help you know what's available to you, kind of like the food I'm trying to find in the fridge. If I don't see it, it doesn't exist. But there's a lot of tools that are available to you. And I want to share with you those benefits, some of which you may not want. That's fine. But if there's something you do want or you want us to discuss, let us know. Your input guides us and helps us become better in helping us serve you. That's the intent. Okay. But hey, look, we love you. That's the reason we're doing this. Okay. And John, I really appreciate your time. I have to say, I'm just going to tell you, I probably enjoy your conversations more than I should. I just do. I just do, man. I mean, really.
Well, one of these times I want to come down there and have something in person together when we can meet all your clients. That would be fun too.
Yeah, you know what? We probably should. Yeah, I have to. Why am I resistant? Maybe I mean I got to stand up in front of a crowd. It's a lot easier to do it when it's digital.
That's true.
All right, I might have to do that, John. I might have to do that. Okay. Hey, by the way, if y'all see you'd rather do this in person and come down to Myrtle Beach and go to the Dunes Club and do see this in person, let us know that too. Maybe that's what we'll do. All right. Well, hey, John, thank you again for your time. Really appreciate it. And client to the clients, thank you very, very much for your confidence in us. We really, really appreciate it. We're here for you. Just let us know in what capacity you'd like for us to help. And whatever suggestions you have, just fire them away. Okay. And the purpose of this is for us to listen and move forward and see if we can help you at a deeper level. Okay. But take care and have a great week. Bye.
See y'all.
Oh, wait, one final question here.
Oh.
I found oh yeah, it was just more of a thank you. Yep.
Oh.
Okay, great.
Dang it, I wanted to answer another questions.
Yeah, you're very, very, very welcome. Thank you very much. And y'all have a great one.
Bye. We'll see you. Bye-bye.